Charge going up, fire in the hole. Go. 1. Left clear, servers on the right, main floor clear, moving deeper.
Room secure.
Left. Multiple terminals, all live. Drives in, pulling the data now. Package secured, moving out.
In this lesson, we're going to cover how prices are actually quoted and filled in the futures market. The bid, the ask, and the spread. Every time you look at your trading platform, you're seeing two prices for each contract, not just one. Those two prices represent the tug of war between buyers and sellers happening in real time. The bid is the highest price that buyers are currently willing to pay. The ask is the lowest price that sellers are willing to accept. Together, they form the foundation of every trade that happens in the market. Think of it like an auction. The bid is the person shouting, "I'll buy it for this much." And the ask is the seller saying, "I'll sell it, but only if you meet my price." When those two prices match, a trade is executed. The difference between the bid and the ask is called the spread. The spread represents the cost of entering the market. It's the small gap you must overcome before you're in profit. On highly liquid contracts like YM and NQ, that spread is usually very small, often just one tick or $5. But that tiny gap matters. When you hit the market buy button, you're filled at the ask price, which is slightly higher. The moment you enter, you start down by the amount of the spread. For example, let's say NQ is quoted with a bid of $15,500 and an ask of $15,525. That's a one-tick spread. If you buy at the ask, you pay $15,500.25. If you immediately close the trade at the bid, you'll lose one tick or $5 before commissions. That's the transaction cost of getting into the market. When liquidity is high during the New York session or when major data drops, spreads stay tight and fills are fast. When liquidity thins out, like during after hours or low volume times, spreads can widen and slippage can occur. That's why professionals always pay attention to the bid and ask depth before entering a trade. Many platforms show the DOM or depth of market. It's a live order book that displays how many buyers and sellers are stacked at each price level. Understanding that order flow gives you a glimpse into the balance of pressure in the market, where large orders might absorb price or where liquidity might dry up. The takeaway is this: the bid and ask are more than just prices. They're a window into market activity. Tight spreads mean healthy participation. Widening spreads signal caution. Always check the spread before entering a trade. If the spread widens, wait for it to settle. Over time, this small habit will save you money and frustration. Remember, your position starts negative by the size of the spread. Manage it, respect it, and factor it into your stop loss and take profit targets. In the next lesson, we'll talk about order types, how to enter and exit the market using market, limit, and stop orders, and when to use each one strategically.